Welcome to the Deep Dive. Today we're cutting straight through the noise from the Louisiana-Pacific Corporation, that's LPX, their third quarter 2025 earnings call.
Yeah, this was definitely a classic two-story quarter.
And the market clearly did not like the cover art, let's say. Led to a pretty swift sell-off.
That's right. We've got the press release, the analyst Q&A, management script, all of it.
Right.
Our mission, really, is to figure out why LPX presented this massive GAAP earnings miss while also raising their full-year guidance. That's the puzzle.
And what that tells us about their long-term shift, away from that commodity exposure.
Exactly.
So we're going to dissect the brutal cyclical pain in their commodity business. Highlight the surprising strength, really, of their branded siding segment.
Yeah, the resilient part.
And explore what's going on with their new capacity plan and that confirmed CEO transition.
Okay, let's start with the numbers that hit the screens first.
Yeah, the immediate shockwave.
Because that initial print was jarring. GAAP diluted EPS, just 13 cents.
13 cents, wow. That's a huge miss compared to the street, right?
Yeah.
What were they expecting?
Consensus was around 51 cents. So yeah, miles off.
Okay.
And net income just plummeted from $90 million a year ago down to $9 million this quarter.
That looks, on paper, like a complete disaster.
It does.
But here's a really critical distinction you need to understand. The adjusted diluted EPS was actually much closer.
Right, much closer. Missed consensus by only a single cent. Came in at $0.36.
So that suggests the kind of operational core was maybe tighter than that headline number implies.
It absolutely does. That huge gap between the GAAP and adjusted numbers, it's mostly explained by one-off charges.
Ah, okay.
Management specifically pointed to $13 million in asset impairments, basically writing down the value of some properties.
Got it.
And also recognizing higher SG&A costs. So yeah, the statutory number got dragged down by these non-cash charges, masking the sort of true operational performance.
Okay, that makes sense. What about the top line? Revenue.
Total revenue was $663 million. That was pretty much in line with what people expected.
Okay.
But still down 8.2% year over year.
Right. And the real pressure point, the thing the market jumped on, was profitability.
Oh, yeah. Adjusted EBITDA dropped a staggering 46% year over year.
46%.
Fell from $153 million last year to $82 million this quarter.
Yeah, the kind of drop, it's hard to ignore.
It is. But, if we connect this back to the bigger picture that management spent the whole call framing.
The two stories thing.
Exactly. You start to realize why maybe the stock is valued the way it is. They're basically running two different businesses under one roof.
And one is doing well while the other's just getting hammered by the cycle.
Pretty much hitting a cyclical air pocket, yeah.
Okay, let's unpack that. The structural divergence. You hear OSB and siding. For those of us not, deep in building products every day, what are these two segments and why are they going opposite ways?
Yeah, it's crucial. The commodity side is OSB-oriented strand board.
Okay.
Think of it like structural plywood. It's a basic input for home construction walls, floors, roofs.
Right, the bones of the house.
Exactly. And its price. Purely supply and demand, housing starts, wildly cyclical.
Got it.
The siding segment, though, that's different. It's a specialty branded product. It's the exterior finish. Focuses on looks, durability, the remodeling market too. That's where they actually have pricing power and brand loyalty.
And the numbers this quarter really show that split, don't they?
Absolutely.
Let's focus on the siding strengths first. That's the core of their long-term pivot strategy, right?
Right. Siding revenue hit $443 million. That's solid 5% growth year over year.
And what's really interesting there is you said that growth came entirely from better pricing and product mix, not just selling more volume.
Exactly. Which is, frankly, highly impressive given how soft the overall housing market is right now.
That really is the sign of a specialty business, isn't it?
Yeah.
They're not just riding the commodity wave.
Precisely. And look at their premium product within siding, ExpertFinish. That's the pre-finished stuff.
Okay.
Volumes for that line grew about 17% year over year. 17%.
Wow.
And this higher value product, it now makes up 10% of the total siding volume, but 17% of the siding revenue.
Ah, so it punches above its weight on the top line because of the higher price.
Textbook example of a successful mix shift into higher margin products. That's the strategy playing out.
And that momentum gives them confidence, clearly. Management said, again, they're aiming to grab, half a point to a full point of siding market share each year?
Yep, reaffirmed that goal.
And to back that up, they've already announced price increases for siding in 2026.
They have. Targeting a net gain of 3 to 4%. That's a pretty powerful statement about their pricing control in that segment.
It really is.
Yeah, they have that power, and they're apparently managing orders carefully now to stop distributors from loading up before the price hike hits.
Smart. Dictating the terms of trade.
Yeah.
That's what you want from a branded company. But then there's the OSB side of the house, the commodity drag. That just seemed to completely swallow up that siding resilience in the overall numbers.
It really did. OSB revenue was only $179 million, down 29% year over year.
29%. Ouch.
And the segment swung pretty violently to an adjusted EBITDA loss of negative $27 million.
A loss. Okay. Compared to what, last year?
Last year, it made $33 million in adjusted EBITDA, so that's a painful $60 million negative swing.
$60 million, yeah.
This segment is just squarely in the cyclical trough. Low prices, lower volumes. It's painful, but it's the reality of commodity exposure right now.
That's a brutal swing. But here's something interesting. Amid that financial loss, how did the operations teams keep efficiencies so high? They hit 80% overall equipment effectiveness, OEE, up 200 basis points.
Yeah, that's actually impressive.
Doesn't that suggest they could have run harder, push out more volume?
It's a great point, and it leads right into their strategic capacity management. They were very clear. It's a deliberate strategy to run their OSB mills down in the high 60% utilization range.
Okay, so they chose not to run harder, even though the machines were efficient. Why?
Because OSB prices were, barely above variable cost, pushing tons of extra volume into that weak market. It would just depress prices even more across the industry and kill their own margins, even if it made their utilization stat look better on paper.
So choosing strategic discipline over just filling the mills makes sense.
It's strategy over, short-term utilization vanity metrics.
Okay, let's shift to the forward view, the guidance. It seems to tell that same story, near-term pain, but maybe offset by the long-term plan.
Exactly. The Q4 outlook reflects this perfectly. For siding, net sales are guided to about $370 million.
Still up year over year.
Still up about 3%, yeah. Mostly driven by price and mix, again, reflecting maybe a slightly softer market than Q3, but still positive.
Okay, but the crucial number, the one signaling the commodity pain isn't over, that's the OSB guidance, right?
That's the one. The OSB segment is guided to an estimated $45 million EBITDA loss in Q4.
$45 million loss just in Q4.
Yeah, a significant expected loss. It signals that this trough is definitely extending. The near-term pain continues there.
Okay, so we have this big Q3 JAP miss, a forecast for a major Q4 OSB loss. Given all that, why did management actually raise the full-year adjusted EBITDA guidance?
Yes. Good catch.
They bumped it up to $425 million from $405 million previously. Why do that amidst all this negative news, resetting expectations?
It absolutely felt like a strategic signal. The raised full-year number indicates that the siding segment's high profitability, plus maybe some internal cost actions, are successfully buffering that extreme OSB pressure better than they initially thought.
So it's management saying, look, the Q3 headline was ugly because of one-offs, but our core profitable engine is strong enough that we'll still beat our full-year promise.
That's exactly how I read it. It's a message of underlying resilience despite the OSB drag.
Okay. And speaking of long-term strategy, the CEO transition, that was confirmed.
Yep. Brad Zadary retiring in February 2026.
Right.
President Jason Ringblom takes the helm.
And Southern pointed out the successful transformation during his time, right? Including returning, what, $4 billion to shareholders?
Over $4 billion, yeah. So this new leadership seems positioned to really execute this next phase of the pivot towards siding.
Which brings up an interesting point about siding capacity investment. We've heard about the Holton Mill conversion project for a while. But now they're talking about maybe converting their Maniwaki, Quebec OSB mill to siding first, potentially bumping Holton down the priority list.
Yeah, that was a key strategic update.
Why this sudden shift in capital plans?
Well, management linked it to the softened housing market outlook. They're not banking on aggressive expansion anymore, more like flat or low single-digit growth.
Okay, so the market slowing down gave them some breathing room to rethink.
Exactly, gave them flexibility. And they're now looking at Maniwaki as potentially a larger scale and more capital-efficient option.
How much bigger?
Maniwaki could potentially produce 400 million square feet of siding. That's a significant chunk of new capacity.
Right.
So choosing Maniwaki first signals maybe a move towards optimizing that capital efficiency, maybe getting bigger capacity online faster. It just reinforces that siding is the absolute focus for future spending.
Makes sense. And before we jump into our trade idea, we should probably touch on the balance sheet. It sounds like they have the financial firepower to actually do this multi-year pivot, even with OSB hurting.
Oh, yeah, definitely. Over $1 billion in total liquidity, $316 million in cash, and pretty modest long-term debt, only $348 million.
So they're not strapped for cash.
Not at all. They can afford the investment. The issue isn't their balance sheet. It's the macro backdrop, high mortgage rates, soft housing starts that's weighing on the whole sector.
Which explains why LPX stock has lagged the building product ETS over the past year.
Precisely. The market is laser focused on that heavy OSB commodity exposure right now.
And that underperformance, that disconnect.
Yeah.
That's where the opportunity might lie.
That's exactly where it lies.
Okay. Now for our segment where we turn analyst consensus into an outrageous but plausible trade idea for the institutional portfolio. And remember, this is not financial advice.
Okay. So the sell-side analysts, they largely maintain buy ratings. Average price targets are sitting around 102 to 106 downs.
Okay, implying what, about 30% upside from where the stock was trading after the call?
Roughly, yeah, 30% upside, yet the stock sold off 8% on the day.
That's the disconnect. Why the 30% upside view if the market is selling off?
Because the core disconnect is the value assigned to that siding business. It's essentially being valued like a commodity business because it's stuck to the OSB segment in the same company structure.
So the trade idea leverages that valuation gap.
Right. We're pitching a long-term, maybe activist-style trade focused on valuation arbitrage.
Okay, lay it on us, the trade pitch.
Long LPX, with a formal proposal, maybe pushed by an activist, to separate or spin off the high-growth, high-margin siding division within, say, 24 months.
Spin-off siding, okay. The rationale.
It's compelling, right? A separation would immediately unlock that premium specialty building products multiple for the siding business.
Get it out from under the OSB shadow.
Exactly. Siding is structurally growing on price and mix. It's targeting more market share gains. It's getting all the strategic CapEx, like that Maniwaki conversion.
That 17% growth in ExpertFinish, that deserves a specialty multiple.
Absolutely. Which is just totally obscured right now by the OSB cyclicality.
And how plausible is this? Could it actually happen?
I think plausibility is pretty high, actually. You've got a strong balance sheet, very little debt. You've got a new CEO taking over next year, confirmed.
A natural point for a big strategic move.
Right. The corporate structure is kind of ripe for it. They're already running these two very distinct operational narratives. Making the separation formal is just the logical next step to align the stock valuation with the actual earnings power of that branded portfolio.
And potentially letting the market finally realize that 30% upside the analysts already see in the siding business alone.
That's the idea. Unlock the value.
Okay, great stuff.
So, to sum it all up, LPX Q3, definitely a necessary cyclical air pocket. That gap miss was severe.
Yeah.
But the structural pivot towards siding, that remains firmly in place. It's supported by real pricing power in siding and disciplined capacity management in OSB.
So you now have the full picture. The deep financial miss, mostly explained by those asset impairments. The resilient siding story. That guided $45 million OSB loss for Q4, showing the trough continues.
Right.
And that strategic shift to prioritize the Maniwaki conversion, optimizing capital under new leadership.
And just remember, this deep dive, it's for informational purposes only. It is definitely not investment advice.
Thank you for joining us for this analysis of the LPX earnings call. We encourage you to keep exploring the implications of this kind of structural shift in building products, other companies trying to shift commodity exposure for branded specialty niches. Lots to watch there.